The American economic engine, after a period of unexpected resilience, is facing a potential roadblock. Projections indicate a significant deceleration in growth, a near stall in economic activity that could ripple through households and businesses across the nation. Forget the robust expansion of recent years. The forecast for 2025 paints a dramatically different picture, one where the gears of commerce grind to a near halt. This isn't just about numbers on a spreadsheet, it's about jobs, investments, and the overall financial well-being of millions. We delve into the factors contributing to this anticipated slowdown, exploring the complex interplay of monetary policy, fiscal adjustments, and global uncertainties that threaten to reshape the economic landscape. To understand the projected slowdown, it's crucial to examine the recent economic trajectory. The U.S. economy demonstrated surprising strength in both 2023 and 2024, defying earlier predictions of a recession. This resilience was fueled, in part, by pent-up consumer demand following the pandemic and government stimulus measures designed to bolster economic activity. However, these tailwinds are now beginning to fade, replaced by headwinds stemming from deliberate policy decisions. The Federal Reserve, in its efforts to combat inflation, aggressively raised interest rates, a move designed to cool down the economy. While successful in moderating inflation to some extent, these higher rates are now starting to exert a drag on economic growth. Simultaneously, government spending is projected to decline as pandemic-era stimulus programs come to an end, further contributing to the anticipated deceleration. The combination of these factors sets the stage for a potentially challenging economic environment in the coming year. The anticipated slowdown in 2025 is not attributable to a single factor, but rather a confluence of forces working in tandem. At the forefront is the lagged effect of monetary policy tightening. The Federal Reserve's interest rate hikes, implemented to curb inflation, typically take several months to fully impact the economy. As these higher rates permeate through the financial system, they dampen investment and consumer spending. Businesses become more hesitant to invest in new projects due to increased borrowing costs, while consumers curtail their spending on big-ticket items like homes and cars. This reduction in both investment and consumer spending directly translates into slower economic growth. Adding to this downward pressure is the projected decline in government spending. The expiration of pandemic-era stimulus measures will result in reduced government outlays, further diminishing overall demand in the economy. The combined impact of these factors is expected to push economic growth below 1% in 2025, a stark contrast to the more robust performance of the preceding years. This represents a near stall in economic activity, raising concerns about potential job losses and a decline in overall economic well-being. The current economic situation presents a paradox. On one hand, the Federal Reserve's actions to combat inflation have been somewhat successful, with inflation beginning to moderate. On the other hand, these very actions are now threatening to stifle economic growth, potentially leading to job losses and economic hardship. The central bank finds itself in a difficult position, needing to balance the need to control inflation with the desire to maintain a healthy and growing economy. This creates a tension between short-term pain and long-term gain. While some argue that the Federal Reserve should have acted more aggressively to combat inflation earlier, others contend that the current policy stance is overly restrictive and risks pushing the economy into a recession. There is no easy answer, and the optimal path forward remains a subject of debate among economists and policymakers. The situation is further complicated by the fact that inflation, while moderating, remains above the Federal Reserve's target, suggesting that interest rates will likely remain elevated for some time, further exacerbating the slowdown. The projected economic slowdown matters because it directly impacts the lives of ordinary Americans. Slower economic growth translates into fewer job opportunities, making it more difficult for people to find work or advance in their careers. It can also lead to wage stagnation, meaning that wages fail to keep pace with inflation, eroding purchasing power. For businesses, a slowdown can mean reduced sales and profits, potentially leading to layoffs or even closures. The overall economic climate affects investment decisions, retirement savings, and the ability to afford essential goods and services. The projected slowdown also has broader implications for the country's fiscal health. Reduced economic activity can lead to lower tax revenues, making it more difficult for the government to fund essential programs and services. This can create a vicious cycle, where reduced government spending further dampens economic growth. The potential for a near stall in economic activity is a serious concern that warrants close attention from policymakers and the public alike. The consequences of a significant economic slowdown can be far-reaching. A weakening labor market, with modestly rising unemployment, could lead to increased financial strain on households, particularly those already struggling to make ends meet. Reduced consumer spending, a direct consequence of economic uncertainty and job insecurity, could further exacerbate the slowdown. Businesses, facing declining demand, may be forced to cut back on investment and hiring, creating a negative feedback loop. The impact could be particularly pronounced in sectors that are highly sensitive to interest rate changes, such as housing and construction. Furthermore, a slowdown in the U.S. economy could have ripple effects on the global economy, as the United States is a major driver of global demand. A weaker U.S. economy could lead to reduced exports from other countries, further dampening global growth prospects. The potential for a sharper-than-expected slowdown in global growth is itself a significant risk factor that could further weigh on the U.S. economy. The future economic outlook is subject to considerable uncertainty. The upcoming presidential election adds another layer of complexity, as the outcome could significantly alter future policy direction. Changes in fiscal policy, trade policy, or regulatory policy could all have a substantial impact on the economy. It remains to be seen how the Federal Reserve will respond to the evolving economic situation. Will it continue to prioritize controlling inflation, even at the risk of further slowing economic growth? Or will it shift its focus to supporting economic activity, even if it means tolerating slightly higher inflation? The answers to these questions will play a crucial role in shaping the economic landscape in the coming years. Viewers should closely monitor key economic indicators, such as GDP growth, inflation rates, and unemployment figures, to gauge the health of the economy and assess the potential for a more pronounced slowdown. The U.S. economy stands at a critical juncture. While recent years have seen surprising resilience, the projected slowdown in 2025 presents a significant challenge. The interplay of monetary policy tightening, fiscal adjustments, and global uncertainties creates a complex and potentially volatile economic environment. The coming months will be crucial in determining whether the economy can navigate these headwinds and avoid a near stall in economic activity. The decisions made by policymakers, businesses, and individuals will ultimately shape the economic future of the nation. The prospect of slower growth serves as a stark reminder of the delicate balance required to maintain a healthy and prosperous economy.